One of the most dangerous features of financial markets is not volatility. It is not complexity. It is not uncertainty. It is delayed feedback. And delayed feedback is psychologically lethal. In most areas of life, actions and consequences are closely connected. If you train consistently, your body adapts. If you neglect your health, symptoms appear. If you study seriously, your performance improves. Cause and effect are visible, clear, understandable. Markets break that relationship. In markets, you can make a terrible decision and be rewarded for it. You can ignore risk management and generate profit. You can overexpose your portfolio and look brilliant. You can concentrate on one asset and outperform. And when that happens, the brain learns something extremely dangerous. It learns the wrong lesson. The reinforcement trap. Behavioral psychology is clear about one fundamental principle. Behaviors that are rewarded tend to be repeated. This is basic reinforcement learning. When an action produces pleasure or gain, the brain strengthens the neural pathway associated with that action. And it does not evaluate whether the action was structurally sound. It evaluates whether the outcome was positive. Markets exploit this mechanism. Imagine an investor who buys a highly speculative asset. No diversification, no risk control, large position size. The asset rallies 30%. The investor feels validated, they feel skilled, they feel superior. The brain associates high risk to reward. The next time, they take even more risk. Why wouldn't they? The system just confirmed that it works, except it doesn't. It worked once. That is not the same thing. Randomness disguised as skill. Financial markets contain randomness, not pure randomness, but significant randomness. Prices move due to liquidity flows, institutional rebalancing, macro shifts, sentiment changes, algorithmic activity, and variables no individual investor can track fully. Yet the human brain hates randomness. It prefers coherent explanations. So when a positive outcome occurs, the brain builds a narrative. I saw something others didn't. My analysis was deeper. My conviction was correct. The story feels real. The story feels logical. The story feels earned. But it may simply be variance. When feedback is delayed, randomness is often mistaken for skill. This is one of the most expensive cognitive errors in investing. Why intelligence amplifies the problem. Highly intelligent individuals are especially vulnerable to delayed feedback because they can construct convincing explanations for their outcomes. If a risky trade works, they can explain why. If a concentrated bet outperforms, they can justify it with data. If leverage increases returns, they can model scenarios that defend it. Intelligence does not eliminate bias. It rationalizes it. When early success appears, intelligence reinforces confidence. Confidence increases exposure. Exposure increases fragility. But fragility remains invisible until volatility expands. The delayed nature of market feedback allows this fragility to accumulate quietly, like structural damage inside a building. It looks fine from the outside until stress arrives. The scaling illusion. One of the most destructive consequences of delayed feedback is premature scaling. An investor experiences early success. Returns look strong. Confidence rises. The natural question becomes, how can I increase this? Instead of, was this repeatable? They increase position size. They reduce diversification. They add leverage. They take larger bets because the brain associates reward with correctness. But scaling magnifies exposure, and exposure magnifies error. If the original behavior contained hidden risk, scaling turns small mistakes into catastrophic ones. By the time the market provides negative feedback, the damage is already large. When feedback finally arrives. Eventually, volatility expands, regimes shift, liquidity tightens, correlations increase. And the same strategy that looked brilliant becomes fragile. Drawdowns accelerate, losses compound, confidence collapses, the investor feels shocked. What changed? Often nothing fundamental changed about the strategy. What changed was the environment. And because the strategy was never tested across multiple conditions, its weakness was hidden. Delayed feedback allowed risk to grow unchecked. And when consequences finally appear, they appear suddenly. Markets rarely punish gradually, they punish abruptly. The emotional impact of sudden punishment, sudden losses create psychological trauma. Not because losses are large, but because the narrative collapses. The investor believed they were skilled. They believed they understood the system. They believed success was controlled. When losses expose fragility, identity is threatened. This often leads to one of two responses: doubling down or complete withdrawal. Neither is rational. Both are emotional. Delayed feedback not only builds bad habits, it builds fragile identity. Process versus outcome. The only sustainable defense against delayed feedback is separating process from outcome. This is psychologically difficult because the brain evaluates results, not structure. But in markets, a profitable decision can be bad, and a losing decision can be good. If a trade respected position sizing, risk limits, diversification, and defined entry criteria, it was structurally sound, even if it lost money. If a trade ignored structure but made money, it was structurally flawed, even if profitable. This distinction is everything. Investors who cannot separate process from outcome will inevitably reinforce bad behavior. Hidden risk accumulation. Delayed feedback allows risk to accumulate invisibly. Small rule violations, minor leverage increases, slight position expansions, tiny diversification reductions. Each change feels harmless. Each decision looks reasonable, until all small deviations combine into systemic fragility. The danger is not one catastrophic mistake, it is incremental erosion of discipline. And because feedback is delayed, erosion is not detected early. By the time stress arrives, structural weakness is already embedded. Why markets are such powerful teachers of bad behavior? In many systems, bad behavior is punished quickly. In markets, bad behavior can be rewarded for years. Think about historical bubbles. Periods of extreme risk-taking can last far longer than rational observers expect. During those periods, cautious investors underperform. Risk-takers outperform. The market appears to validate aggression. But eventually regime shifts occur, and the cost of accumulated risk becomes visible. The lesson arrives late, but when it arrives, it is brutal. The correct framework. Instead of asking, did I make money? Ask, was the decision structurally sound? Instead of, how much did I earn? Ask, how much risk did I take? Instead of, was I right? Ask, was I disciplined? This reframing shifts evaluation from outcome to behavior, and behavior is controllable. Outcome is not. 3 practical safeguards. First, delay scaling. Require a meaningful track record across multiple volatility regimes before increasing size. Second, define maximum exposure rules in advance, not after success. Third, conduct process audits independent of profit. Review trades as if profit were hidden. Judge structure, not result. This builds robustness. Robustness survives variance. Fragility does not. Final perspective. Markets are not dangerous because they are uncertain. They are dangerous because they can reward you for being wrong. Delayed feedback creates illusions of skill, illusions of control, illusions of safety. And illusions are most dangerous when they feel justified. If you remember only 3 things from this video: first, profit does not validate process. Second, early success is often the most dangerous phase. Third, evaluate structure independently from outcome. Markets do not teach immediately, they teach eventually, and eventually can be expensive.